Hi, everybody. Dave Fry, ETF Digest, with another podcast. Again, this time we're happy to have with us Charles Rotblut, who is head of the AAII, which is the American Association of Independent Investors, who we've done these interviews with before, and I've been blessed to be able to write an article for them in their ETF guide. Charles, tell us a little bit about what the AAII is all about. And welcome.
Sure. We're a nonprofit focused on individual investor education. We have about 150,000 members, and we really try to provide objective information on really all aspects of investing. Our focus is really education and information. So versus where there's a lot of firms that provide recommendations, we're really trying to teach people how to properly manage their portfolio and really cover all aspects of portfolio management.
What does the membership cost for something like this?
So the cost is $29 a year. We actually publish a monthly magazine of which I'm the editor, the AAII Journal, and then I also write a weekly newsletter for our subscribers in addition to that. But our primary publication, or really our top publication, is the AAII Journal, which comes out monthly, and we do that 12 times a year.
And for all our ETF Digest readers and listeners to this, I want you to know that Charles has kindly offered a 6-month trial subscription, and the username and password is posted on the video as you see. That's very nice of you. Thank you very much, Charles.
Oh, it's my pleasure.
Now, Charles has just released a book entitled Better Good Than Lucky, which is a spin on an old "I'd rather be lucky than smart" phrase. So, Charles, tell us about the book.
Sure. The book, it's pretty short. I try to make it easy to read and easy to understand language, and it really tries to tie in a lot of the concepts that have been published in a lot of the great investment literature over the years, really pull from those concepts as well as apply some of my own experience and knowledge. But I really follow a Warren Buffett type approach in the book where I pull from Benjamin Graham, who really emphasized low valuation, but I also pulled from Philip Fisher, who really emphasized the importance of the business model. And a lot of times when people think about Warren Buffett, they think about value, but they're forgetting that he also places a lot of emphasis on management and how well the business is run. So I do talk about that. And the other thing, I do talk about portfolio management and diversification, tie in Harry Markowitz. But one of the important things in the book is I also stress the importance of just keeping a trading journal. And before you make any investment, think about what the risks are and write down what could cause you to sell the investment before you buy it. The rationale being is that you have no emotional attachment, you have no money at risk, so you're going to be more cognizant of what could cause you to sell. That way, if something does go wrong or if the investment goes in a manner that you did not expect, you at least have something that you wrote down that tells you what to do in that type of situation.
So like us, it's to remain systematic in terms of what you're doing, although we may approach it in a different way. Nevertheless, there is a systematic approach to being in something or not in.
Yeah, absolutely. And I think regardless of how you look at the market or how you look at stocks, it really comes down to that you're always constantly trying to analyze what's the potential for profit and what's the potential for downside risk. And it really comes down to properly managing that. And in any investment, you obviously want an investment that gives you more upside than downside risk, but you have to be cognizant that there is always that risk and have a plan for dealing with it.
The AAII has chapters all over the country, right?
Correct. We have about 50 chapters throughout the country.
I was fortunate enough to speak at your Atlanta chapter about a year ago or so. Looking forward to doing another one of those at some point. Charles, now, one of the things that you produce, which is always of interest to investors, is the sentiment surveys. And tell us about the current views versus historical. You just sent me a very nice summary of all that, but share it with the listeners.
Sure. A little quick background. We've been doing our sentiment survey since 1987, and the question hasn't changed. We just ask investors whether the stock market's going to rise, stay essentially flat, or fall over the next 6 months. And we saw bullish sentiment actually drop to its lowest level in actually 10 weeks. It's now at 42%, but that is still above the historical average of 39%, and we've seen it stay above its historical average for now 21 consecutive weeks. And to put that in perspective, we've only seen bullish sentiment stay above average for this long of a period once one other time in the whole 24-year history of the survey, and that was in early 2004, where we saw bullish sentiment stay above its average for 42 consecutive weeks. And it's interesting because if you look at where the economy was in 2004, relative to where it is now, at similar points in the recovery. So it is questionable whether or not we will see a repeat of 2004, but there's definitely some similarities. Third year of a presidential cycle. We're looking also at an economy that's about 18 months out of its recession. So we'll have to see whether or not we actually get a repeat, but we are seeing bullish sentiment stay above its historical average.
I thought last year, for example, 2010, reminded me very much in terms of action of 2004 in its behavior, with a bad summer followed by a rally just after the election and into the end of the year. And then 2005 was completely different, obviously. But 21 weeks, 42 weeks, a lot of this also has to do with Fed policy at that time. In other words, the Fed was very accommodative in 2004, 2003. Of course, they're super accommodative now. Do you think that has a big impact on how people approach things?
I do. And one of the response to the survey this week, I always ask a special question. This week was whether or not they're taking on more risk as of late. One member responded, well, if the Fed's giving out free money, I'm going to take on more risk. So I definitely think that's playing a role. You have the Fed that's really trying to keep the economy moving. And we also have President and Congress, which just gave workers an extra 2% pay raise this year, and hopefully that should help as well.
Do you think the policies of the Fed are inflationary in any particular way, or is that your sense of things? Or are you buying into the idea, as the Fed statement yesterday was, that I believe they're really looking at the core rate of inflation is declining, but as we know, when we look at inflation from at least commodity prices, they're soaring as far as food and energy is concerned. What do you think of that?
Yeah, I think the Fed's doing everything it can, but I think the Fed is really out of bullet and it backed itself into a corner. Inflation is definitely a long-term threat, and certainly over the short term we're seeing it, like you said, in food and gas prices. I think we'll have to wait and see. There's a really large, massive room for error in what Bernanke has done, and we'll have to see how quickly he is able to react and keep inflation from getting out of control if the economy really gains some steam and we really start seeing this recovery take hold. Certainly right now the rise in commodity prices is definitely a concern, especially for people who are already struggling. Seeing the price of milk and cereal and other basics go up is just another problem for them, and it definitely hurts them. So
it's like a tax for many.
Exactly.
So tell us about current fund flows and what people are actually doing with their money. There has been a lot of withdrawals from mutual funds up until recently, and by recently the last couple of months, I guess. What are you seeing now?
Yeah, it's interesting. We have a couple. Lipper follows them, and also the Investment Company Institute, the ICI, follows them too. And their numbers are showing that flows to domestic funds have actually been positive 3 of the last 4 weeks. So it's signaling that money's coming back into mutual funds. It's interesting because all through, really most of last year, the second half, we saw money flowing out of mutual funds, but our sentiment survey was running very bullish. Our asset allocation survey, where we asked members what they're doing with their money, we started seeing people put more money into stocks, so there was a little bit of disconnect. And it could be because the ICI data tracks 95% of mutual fund flows, that it could be people who weren't following the market as closely or holding off, and now maybe they're buying in possibly too late into the current leg of the rally. But we are seeing definitely the fund flows shift more towards domestic stock mutual funds.
Are retail investors always wrong, as the saying goes?
Yeah, it's and I think you need to divide it up into a group. I mean, our members, we do spend a lot of time educating them, and I think compared to someone who's not really staying on top of their finances, our members are more educated and more aware of what's going on in the market. But I think when you look at mutual fund flows, we do have to realize it also includes a lot of the 401k dollars, and you do have a lot of people that are investing in mutual funds purely through their job, and they're reading the headlines, but they're not being proactive in managing their allocations and managing their funds. And I think that's one of the big mistakes that a lot of investors do, is they don't be proactive. They don't think about, well, how should I be allocated? Where should my money be going? They're more reactive, and when they see the market doing one thing, they react, and then if they see the market doing another thing, they react, and usually those reactions are too late, and usually for the wrong reasons.
Have you seen a shift of any kind from mutual funds to ETFs? I mean, obviously ETFs assets are growing, and it would be logical to see more people go to ETFs than mutual funds, although many people are locked into plans. What are you seeing there, if anything?
Yeah, I'm seeing some evidence on, obviously with the fund flows, we're definitely seeing that in terms of the numbers and the dollars amounts in terms of ETFs, we're definitely seeing that growing. We haven't really surveyed our members as to what they're doing, but I do hear from members that they are switching. When you look at some funds, all things being equal, if the ETF's cheaper and there's really nominal transaction costs, it makes more sense to go with a cheaper fund. And I've had some people ask me, and I think for most investors, when they look at it, it's not a question, should you be holding ETFs or should you be holding mutual funds, but what is the best fund for you? If you're looking at an index fund and you can get cheaper expenses through the ETF, it just makes sense to buy the ETF over the mutual fund. And I think we are seeing an increasing number of investors realizing that I can still achieve the same returns and the same investment objective, but get it for a lower cost, and that is causing some people to move money from mutual funds to ETFs.
All right. Well, Charles, that'll probably do it. That's probably as much as anybody can absorb in one listening. I thank you for being with me, and I hope we can do this again another quarter or two.
That sounds great.
Thanks for being with me.